Kyle, so good to see you. Today, we are going to talk through 4 ways to improve your investment performance. This doesn't mean taking on more risk or chasing the latest trend. Often, it's about getting the fundamentals right. So, let's walk through 4 simple ways investors can improve their investments without making things more complicated. Number 1, automate and then get out of the way. That means automating contributions, your investments, how often you rebalance. What else, and how does this help?
For sure. This is a great topic, Aaron. And the big distinction I want to draw here is that there's a big difference between trading and investing. And today we're talking about
Right.
investing. We're not talking about trading. Trading is where we're trying to make a quick profit, maybe on some, price distinctions in the market or something like that. Investing, we're talking about creating a plan for some money and investing it for a specific purpose or a specific period of time. And when it comes to that, one of your biggest enemies can be the emotions. And that's what we're talking about, getting out of the way here. Is let's just try to take those emotions and get out of the way. And the easiest way to do that is to build a plan for that money that we're investing. And namely, having a investment philosophy that you believe in, that you can have conviction in. That's the most important thing. If you're working with an advisor, they too should have an investment philosophy, a set of rules and beliefs in the way that they invest, and then you stick to the plan, and then you automate, just like you had said. How are you contributing to that account over time? Your rebalances, everything should have a plan associated with it.
Right. Right. Number 2, consolidate. If you have old retirement accounts floating around, managing your money becomes harder, and getting a look at your whole financial picture becomes even more difficult. So this is an easy and often overlooked step.
This is a big one, and you wouldn't believe it. I mean, we've got clients that, we brought on as clients when they're getting ready to retire. And, we work multiple jobs nowadays, especially since COVID. We'll see people with, several different jobs in a quick period of time here the last few years. But these clients that we're bringing on, sometimes they'll be a client for a couple of years, and next thing you know, they'll say, "Hey, you know what? I got this in the mail. What is this all about?" And lo and behold, it's an old retirement account they have totally forgotten about. We see it every year. And you don't know how those things are invested sometimes. Could just be in that first investment that you picked way back when. And then what kind of fees they're charging you. Maybe you're paying someone to manage an account that you completely forgot that you even had.
Right.
And that's not a good problem to have.
No, absolutely. All right. Number 3, define your time horizon before investing. And this one can help guide your decisions when it comes to buying, selling, or holding an asset.
Yep. And this is a really important element to that investment philosophy that I was talking about, is, assigning that rule of, okay, well, if my money is going to be invested, if this money right here is going to be for the down payment on my house next year, you're probably not going to want to take a bunch of moonshots and buy a bunch of risky stocks with that money, because you're going to need it. And on the flip side of that coin, if it's money that you're investing for retirement, you want to make sure that you put into perspective, when is that going to be for me? And then you pick the right investments, or do your best in your research to figure out what's going to fit that mold for you.
Right. All right. Number 4, I feel like this one is a little bit easier said than done. Save a little bit more money every year.
I know, you hear it all the time. Just save more money, right? But the clients that we've worked with that I think have been the most successful at saving money, just people that have worked for a long time and saved money. Every time they've gotten a raise, or they're making more money at their job, or they've had a good year, they always take a piece of that and start saving a little bit more of it. So it's not like you're trying to diminish your way of living each year necessarily. You're just changing, and you're capitalizing on the good things and the good times in your life, and putting some of that aside for a rainy day or for your future.
Right. Has to be part of that plan, which you mentioned at the very beginning. So, Kyle, if somebody wants to talk to you about improving their investment performance, which comes back to having a plan and a purpose for each dollar that comes in, what's the best way to reach you?
For sure. The best way is through our website, and that's firstcoastfinancialgroup.com.
Great. Kyle, thank you so much.
Thank you, Aaron.